Hello traders, this is Blake Morrow. You are listening to the week ahead video for April 11th, 2011. I hope you guys are having a great weekend. Filming this a little bit early. We had a few things that are going on over the weekend, and actually I'm going to keep it fairly short today, so I'm just giving you a little heads up. But before I actually even get started, let me just say a couple of things. First of all, thank you for listening to these week ahead videos. I really appreciate it. And what I also really appreciate is how much support that you and all the fellow trading community folks have given us over the years. With that being said, if you're watching this on YouTube, please give us a thumbs up. We really appreciate it, especially myself. We do these every week for you. They're free, and I hope it really helps prepare you for the week ahead. So if you like this, please share, please subscribe to our channel, and please leave a comment below if you agree with what I'm saying. Maybe if I missed something, which believe me, I miss a lot of things. So if I miss something, jump in the comments and remind everybody that there's this happening or that happening. Hey, I appreciate that, and so does our team. So thank you very much. Also, if you haven't tried out ForexAnalytix, I'll keep this short. Just please do so. It's $1 for 10 days. Try it out. And then when you do that, jump in our chat rooms. Chat rooms where it's at. So not only do you get this great technology and you get this on your mobile devices, but then you get to jump in the chat room where I'm at all day. We've got about 100 traders in there every day. There's a lot of talking going on. And a lot of ideas, and that's where I find a lot of these ideas that I go through throughout the course of the week. So, matter of fact, I want to show you something. This is a really good example going into the week ahead of something that I wasn't looking at, but one of our traders in Greece, Takis, he was looking at, and I was looking at, this is the 10-year yield, and I'm going to get rid of this pink line here. And I was looking at the 10-year treasury like this, and I'm like, okay, we broke out of this channel support. We're nearing horizontal support. And this was on Thursday. And he said, he's like, hey, Blake, I see what you're seeing, but you know what I see? He goes, I think we're in a bigger channel. It looks like that. That was on Thursday in the chat room, and he posted the chart. And guess what? We bounced from there. And I'm like, dang it, that's right. And so what that really actually tells me going into this next week, how important not only that channel support is, but how important that both the channel support and this horizontal support is, because I think a lot of us have been looking at yields saying, okay, they've rallied quite a bit. Bonds have come down quite a bit. The market's extremely bearish, the bond market. I think positioning would show you that. And what happens if bonds actually bounce back? And why would they? And one of the reasons that bonds could actually bounce back and yields could come down is because we might see some risk aversion. Now, I know. This is one of the reasons why I was going to keep today's video fairly short, because the playbook's still the same for me that it was last week. And last week, you ever have those trading weeks where you just spin your wheels? I mean, I have good weeks, I have bad weeks, and I definitely have weeks where I just don't do anything. Well, I do stuff, I trade, I just don't make any money. That was last week. Last week, I had this same playbook from last week where I'm like, okay, the stock market is at, nearing some resistance up here. You can see, right, this is last week, right? We were going right into resistance, and I'm like, okay, we're at the 127% extension. I'm taking you back to last week, right? And I'm like, we're up against resistance, but what I'm looking for is if we see a turn lower in stocks and we start to come back down towards support. Again, I'm speaking from last week. Go watch last week's video if you want. Then if that happens, we should see a rally in some of these currencies, like the US dollar, Norwegian krona, which I'm still monitoring. Let me remove that for a second. I'll come back to that chart here in a second. But, I was looking for things like that. And guess what the US dollar and Norwegian krona did all week? Nothing, really. It didn't do anything, but guess what stocks did? They continued higher. Now, we are really up against some pretty key resistance. And it is pretty remarkable how stocks don't come down. I mean, I know we've been saying this for a long time. I say we mean, we all sit here and look at the market the same way every day, and we go, man, I cannot believe the pullback has been as minor as it have. I remember when this rally right here, going back to, around the fall of last year, we're like, okay, we're at new all-time highs. And, looking at the market, we go, oh, well, the pullback has been so minor. We barely even, I mean, look at this move. You look at this previous move, we didn't even have a 38% pullback. So whenever you get such a shallow move like that, we knew that it was going to be another rally at some point. It's just going to continue. And lo and behold, here we did. We continued into the end of the year, or in the beginning of the year. And the market hasn't stopped. If you look, this is the S&P, guys. In the S&P, since the beginning of the year, I mean, we're up, 7-8%? Let's go do the math here. So 31st. Oh, I'm sorry. We're up 12%. Sorry, that's the S&P. We're up 12%. NASDAQ's almost at all-time highs. And the Dow's up like 11 or 12% as well. All right. So the markets are just, continuously moving higher. Pullbacks have been very minor. But we are up against resistance, and I'm going to leave you with this. Not leave you with this. I'm going to leave you with this idea. The same idea as I had last weekend. There are currencies that are diverging away from the market. Commodity and emerging market currencies. The emerging market currencies had a good week this week. You look at the Mexican peso. The Mexican peso played a little bit of catch up with stocks. See how the dollar mex had come down. South African rand, same thing. We dropped for a few days because when stocks go up, emerging market currencies are going to be more in demand. They tend to have a higher yield. Their central banks have higher rates. So naturally, they're going to be a little bit stronger. And when stocks continuously hit highs, that's what's going to happen. You're going to see a drop in the dollar and a pickup in rand or the peso. But look at how much movement we've seen in 5 days of equities going up, and then 5 days of the US dollar, South African rand. Here's the US dollar, Mexican peso in 5 days. Okay. Not much of a movement. So what happens when stocks actually correct a little bit? If the stock market corrects just a bit, and as I tell you guys every week, look, it's going to take a lot to break this bullish trend in the stock market. It just is. I mean, the stock market is strong. We're going to have to break some serious support, much further down before it rattles anybody's cage as far as being on the long side. Dips will be bought for some time. Even if we have a slide in May, you get the sell in May, go away, seasonal trade happening. Even if that happens, we're going to see buyers on dips. Okay. But what happens to some of these currencies that have just been basing, and like like Norwegian krona hasn't rallied in all of 2021. In all of 2021, the US dollar Norwegian krona has been basing. So what happens when stocks actually go down and they correct? Even if it's a 5% correction, even if it's a 3% correction, where does that put the US dollar Norwegian krona? I would think higher. Where does it put the Aussie dollar? I think lower. Again, look at the Aussie, look at the head and shoulder pattern, and notice how it's diverged away from the S&P in recent weeks. S&Ps continue to go higher. Let me make this a different color for you guys, just to really make it stand out. Let's make it green. Now you can really see the divergence. S&Ps go up, Aussie not so much. So what happens when the S&P corrects? The Aussie will go lower. Kiwi same thing. Canadian, stop going down. And you know what? Let's stop and talk about Canada for a second. If you guys follow me on a daily basis, and let me stop right here, because I said if you follow me on a daily basis, if you go to our website, ForexAnalytix.com, go to our webinars, and you'll see the free F.A.C.E webinar. The link is also in the description of this video. So click here. It's a Zoom meeting. I know a lot of you guys know how to use Zoom nowadays. And again, we used Zoom before Zoom was cool. So there, take that. But jokes. I shouldn't be joking. I'm going to keep this serious. Anyway, register for that, so you kind of know my outlook on a daily basis, and it's free to attend. Those of you that know, I'm long dollar CAD. I've been long dollar CAD for the last couple of weeks, waiting for the same trade. I'm waiting for it to actually bounce, when stocks come down. But you can see the dollar Canadians had this inverted head and shoulder pattern developing, and Canada's COVID situation and lockdowns they might get the market's attention. I know Canada just had great economic data on Friday. They had blowout jobs numbers. That's awesome. And of course the Canadians strengthened. But it hasn't broken down either. And I still think we're developing this inverted head and shoulder pattern coming out of a descending wedge, which both of those patterns are actually bullish reversal patterns. So again, the only missing ingredient here is the equity markets. So with that being said, let me go ahead and get rid of the S&P here. Let's go back to the S&P, and let me talk about a couple of things that I think you should be paying attention to based on where the S&P is at. We look at sentiment. It's one of the many ingredients that goes into our factoring on what we think might happen. And what we think might happen and what happens obviously are two different things. I have expectations what I think the market's going to do, and they don't always meet my expectations. But when they do, that's when I tend to be more aggressive as a trader. So what I'm telling you is, if I plan a trade, or I have an idea in my mind, and then it comes to fruition, I tend to be more aggressive and tend to make more money when that happens. So right now, one of the ingredients that we've seen is daily sentiment readings for the S&P are in extreme bullish territory. They are registering above 90, which on a scale between 0 and 100, anything above 90 is very extreme. And whenever you get these extremes, they don't stick around for too long. They usually come down within a couple of days, and so does the market. Usually the price would follow. So at these extremes, that is a concern. Also factoring in the, just simple idea that we are at 161% extension of the decline from mid-February to the beginning of March, 161% extension. Also, the 161% extension is just above from the COVID high, post or pre-COVID, lockdown, the highs to the lows post-COVID lockdown. The 161% extension comes in at 4150 roughly. We are within 25 points of that in the S&P. That's a huge golden fib level, and we have multiples of those. With that and extremes at highs, there is a good chance this next week we will see a pullback in equities. Also, volatility. One of the best trades over the last year has been short volatility as stocks have recovered. I think a lot of traders and portfolio managers and asset managers, hedge fund managers have all been scratching their head, especially this year, 2021, that volatility spent all of 2021 up until this last week above 20, where volatility historically has been, when we were at all-time highs previously, we were down in the 10 to 12, 15. We get spikes up, a little bit of pullbacks in equity prices, we'd see a spike up in volatility. But volatility really has been perched at a much higher level post-COVID lockdown. Well, finally, we filled the gap. Was it last week? We filled the gap, but VIX DSI is registering at 10, which is also a bearish extreme. So that means that we probably won't hang around these levels, these low sentiment index reading levels too long, and they might snap back. And that higher volatility is usually associated with equities coming down. And if equities come down, then that means that the dollar, and this is where I'm going to leave you, what I'm going to leave you with today, is the dollar might come out of this bearish channel sooner rather than later. Now, if you're looking at the dollar index, you know, we had an ascending wedge. We broke out of the ascending wedge. We've pulled back now, and we've spent the last, was it 2 weeks really, just kind of retracing some of our steps that we've had in the dollar index. Dollar index, and you guys remember this from last week, or last week and the last 2 weeks on the same week ahead video, we were challenging the underside of this trend line. Remember, it's pink, and I'm going, yeah, you know, this pink trend line, you guys see it, right? Right here. Okay, multi-year, it's actually 2011 all the way to, you know, today, which, you know, 10-year trend line. Of course we're going to reject it. We rejected it. And we spent literally the last 2 weeks pulling back a little bit. But you know what? We're at a 618 retracement of the last move higher. The last move higher. We're at the 618 retracement. You can see it right here, right? 618. Whoops, 618. Now we've barely pulled back, and we haven't even pulled back a whole 38% retracement. So let's just say, thinking about my words from earlier, when you have a shallow retracement, if the dollar index starts to take off again and we get back above the 200-day moving average, how many sell orders were triggered when the dollar broke below the 200-day moving average? Yeah, let's imagine some of those near-term shorts get squeezed out. Then we hit new highs. How much further can we go? Well, whenever you have just a 38% retracement or less, like we had here, there's a risk that we actually go even further. And then you start to complete like an AB equals CD move, which would be something like this. A, B, C, D could take us back to 95.60. And holy cow, would that squeeze the hell out of dollar shorts if that happened. I'm not saying it's going to happen, but we've gone a long way in equities. We've gone a long way in the S&P. And even if we have a 8 to 10% pullback, would that be enough to drive the dollar back to 95 or higher before we start resuming this longer term downtrend lower? It's possible. And what I've learned, if you haven't learned this over the last year or 12, is that anything can happen in the markets. Anything, right? All right, guys and gals. Hey, again, I'm gonna say, if you think this video is going to be beneficial to you going into this next week, hopefully we won't spin our wheels like a gerbil or a hamster in a hamster ball. But if you think this video is going to be beneficial to you, give us a thumbs up. Give me a thumbs up. Like, share, subscribe. Like the video. Share the video on social media. Share it with your grandmother. I don't care. And subscribe to our channel, so this way you don't miss any of our great interviews that Dale Pinkert does throughout the course of the week. And I'm going to tell you this: if you've made it this far, I'm going to give you a little bit of I'm going to give you a little heads up. Did you make it this far? Congratulations if you did. We have some really cool stuff planned for you guys in the next few weeks, so make sure you are subscribed to this channel. You're going to see some cool videos coming up, and I'm excited. I hope you are too. All right, guys and gals, my name is Blake Morrow. Have a great remainder of your weekend. I'll see you tomorrow morning on the F.A.C.E webinar. Bye-bye.